Okay. Again, good morning, everyone. So we can today it's the third day of week 11, so we can start the session um, um, like integrating robust risks or risk analysis into our portfolio management. So let me share my screen and let us start. Okay. So understanding robust risk analysis. So we can so in this week, we're trying to analyze different type of stock markets for different companies or yeah, using their names. So the point is, how are we like we're trying to predict how it is going to continue, how the market is going to continue for every um, company, right? So like while doing this, there's a risk. A risk that the companies needs to consider. So what type of risk are we supposed to analyze? Are we from what angle are we supposed to see those risks? Are the details. So in the first place, what is robust risk analysis? So it's a comprehensive approach to risk management that consider a broader set of uncertainties than just market volatility. So there is this common risks that we assume that it will happen. Like, that is the market volatility. So in our document also we have assumed there's a high volatility on Tesla and others might be stable or something. So that is kind of the risk that we can directly assume that there are different type of risks. So when we're using robust risk analysis, we try to see that type of risks that are maybe hidden. So it's focused on preparing a portfolio to withstand extreme unexpected events and various adverse market scenario. So not just typically fluctuations. So the goal is to build a portfolio that is resilient and performs reasonably well even when it chooses a model or a forecast is wrong. So yeah, at the end of the day, we're preparing a portfolio. So how can our portfolio can withstand another type of risks or fluctuations that are not expected or that might happen because of different reasons. So how are we able to how actually our portfolio is able to withstand that? Maybe in the case of like our model might not perform well, maybe that could be the issue, but at the end, how can we stand those type of risks? And moving beyond standard metrics, so while metrics like standard deviation and Sharpe ratio are foundational, they have limitations. So standard deviation, for example, assume returns are normally distributed and treats upside and downside volatility equally. So this section will introduce more advanced metrics that specifically target downside risks. So maybe to manage risks, we usually assume these two things, so the standard deviation and calculating the Sharpe ratio. So I have started the recording, right? Yeah. So while metrics like this matrix, the standard deviation and the Sharpe ratio might be one of the foundational keys or metrics, they have this type of limitation, which is the standard deviation. It assumes always returns from a market are normally distributed and treats upside and downside volatility equally. So it might be the volatility might be in both directions. So it treats both direction equally. So it is not trying to see different type of reason that this volatility is happening because the reason behind this volatility. So we can address or advance our metrics in order to target both side of the volatility or both side of the risks. So yeah, we can like here we're going to identify like the key concepts, and we're going to see them in details below. So the value at risk or VAR, it's the maximum expected loss over a given time period at specific confidence level. So we're trying to put a risk, or we're trying to say there is this amount of risk for this business and for in duration of maybe daily or monthly or something, right? So uh, we're assuming that there's a limitation for our model or something, because we're calculating risk at the end of the day. So we are expecting a loss over a given time, a time of period. So the maximum amount of loss that we're expecting over a given time of period at a specific confidence level. So like if our confidence level is 95%, the portfolio won't lose more than 5% in a single day. So it's just we're putting our confidence on our portfolio. So this is the value at risk. So the risk value, or the risk value, or the loss that we're estimating is 5% in a single day. Conditional VAR, it's the expected loss that occurs in the worst case scenario beyond the VAR. So on the VAR level, we'll just put our expectations. So anything that is going to, any loss between the number that we have stated here is not going to surprise us, or it is expected. So we will try to put a strategy that can overcome this 5% loss, right? But there is a conditional value at risk, which is the expected loss that occurs in the worst case scenario beyond the VAR level. So it often seen as a more robust measure than VAR because it accounts for the magnitude of loss in the tail of the distribution. So yeah, it can. The point is, it can see more robust measures. It can help us to take that type of measurements, because it is trying to see risks or values that are beyond the VAR, beyond the values that we have set for the VAR. Stress testing scenario analysis. So this is simulating how a portfolio would perform under hypothetical but plausible extreme events such as 2008 style financial crisis or sudden geopolitical shock. So we can just see how our portfolio can handle stress. We can just simulate that so that we can see, we can use some examples of like happening or something related with our scenario, like a negative example. That means, so that will help us how our model or our prediction uh, will act for that specific happening or scenarios. So on varying sharp ratios, they are the first look, or the first thing that we calculate by taking analyzing the risk, right? So what is VAR? As we've mentioned, it's a single number that tells you the maximum potential loss you can expect from your portfolio. Okay? So the maximum potential loss you can expect from overall your portfolio, and also in a given period within a given probability is VAR. So let's say a 1 day 95% VAR of 1,000 means you are 95% confident that your portfolio won't lose more than 1,000 in a single day. Okay, so 1 day it's 95%. Value at risk is $1,000. So like we are very sure that maximum we can lose $1,000 per day. That's going to be the maximum. So, but it doesn't tell you the other of the days where you lose more than 1,000, which is where the conditional VAR comes in. Okay, so like whatever, if we keep like in our prediction, if we keep like getting a loss of 1,000 in the markets, so we can explain that using our VAR. That if like some days we get a loss more than that, or more than the maximum value set by the VAR, then we need that is where the CVAR or the conditional VAR, the conditional value actually comes in. So the Sharpe ratio, this measures an investment risk adjusted return. So it helps you figure out if the extra return you're getting is worth the extra risk you're taking. So a higher Sharpe ratio is better. So it means you're earning more return for each unit of risk you're taking. So there are different types of risks that we're going to take, right? Or that the company is going to take, right? So everything is risky, right? So, but the point is, if we're taking a maximum risk, but if there is a chance, or if there is a chance that we are going to achieve the need, So there, the achievement will have more return. So what is the level of return? So the point is, we're not going to take a major risk or like a bigger risk for a little amount of returns. That, I mean, it doesn't deserve it. So like, so the Sharpe ratio will help us to adjust that. So if the Sharpe ratio feels like we're taking more risk and we're having a lower amount of return for that specific risk, then it's not worth it. Okay, so we can just leave taking the risk, and we can just yeah, we will try to minimize that risk. So a higher Sharpe ratio is better. It means you're earning more return for each unit of risk you're taking. If you have if you have two portfolios with the same return, the one with the higher Sharpe ratio is more efficient because it achieves that return with less volatility. So if, yeah, for the same amount of return, yeah, we can take the one with the higher Sharpe ratio. Like, it means that it achieves the return with less volatility or with less risk, because we're having the same type of return from two portfolios. And then the one with the higher Sharpe ratio, it means that it have literally lower risk value. So we will prefer that. And the standard deviation, so it's a statistical measure that quantifies the amount of variation or dispersion of a set of data values. In finance, it measures how much an asset's return deviates from its average return. So there's the average return that we understand the concept of standard deviation in statistics, right? So how is the number is going to deviate from its standard value? So if when we bring this concept to finance, it means that there is the daily return or the standard return that we expect the company to have or to return daily or monthly. So the amount of the deviation that or the amount of change that can differ that can deviate from the standard value is called the standard deviation, or it will measure that number. What it means for risk, so uh, it's key proxy for volatility. So a high standard deviation means an asset's price fluctuates widely, making it riskier and less predictable. So like fluctuation means it might also increase, it might also decrease. So it's a plus and minus. But also, even if it's a plus, it's telling us that the price that we're trying to predict is literally unpredictable or risky, or it might not have a constant change throughout the months or throughout the days that we're trying to predict. Okay, so the more volatility we have, the more standard deviation, or the more the number is deviating. It means that it's risky, and we need to be more careful while making the prediction. So, for example, think of two cars on a road trip. So the first car drives consistently at 60 mph, or which is like the low standard deviation. So the second car might range to from 90 to 30 meter per hour. So the highest, which is the second car, have higher standard deviation. So while they might both reach the destination at the same time on average, the second car journey is much riskier and less comfortable. And you cannot tell, like, if you're staying at some place, you cannot tell that the second car will might be here safe. So like the second car is more riskier. So the same concept will just apply on the finance data or finance case. Okay, and then the C-bar, or the conditional value at risk, it will try to capture the worst case scenario. So also known as expected shortfall. So which CVAR is more advanced and robust risk measures than VAR. So while VAR tells you the line in the sand for your potential loss, CVAR tells you the average loss you can expect to incur on the bad days, such that on the days when your loss exceeds the VAR. So at the end of the day, what we're trying to do is to understand the risk, or the amount of the risk that we can face, and trying to put some values that can overcome them, right? So for the CVAR, okay, the CBAR will help us to put there is definitely going to have, on business or on this type of financial sectors, we're going to have a days that we can exceed, or that we can literally fail to achieve the amount of return that we need or that we assume. So on those type of days, what are the mitigate the yeah the mitigations, or what are the factors that I'm going to take or that I'm going to consider in order to overcome this challenge. So VAR doesn't account for the magnitude of loss beyond its threshold, right? CVAR, however, gives you a better sense of the true or a tail risk, or the risk of catastrophic loss. This is why it's a popular tool for portfolio optimization. So as you can build a portfolio that specifically aims to reduce the extreme loss, not only the loss that we expect, but also the extreme loss, because many financial sectors or something that is dependent on this might not be able to overcome this type of loss. So having this type of analysis from the beginning will help us overcome those things. What do we mean by stress testing in scenario analysis? Is it's asking why. So as we mentioned earlier, we're going to have scenarios that might help, or that might affect, that will definitely affect our business or the finance or that specific stock market in a bigger form. So while testing the stress, it involves running simulation of extreme but plausible adverse market conditions to see how your portfolio would perform. So it is a quantitative, so what if experience. For example, what if interest rates rise by 2% in a single week, okay? So what if a major geopolitical event caused the S&P 500 to drop by 15% overnight? So like this is a very like if the interest rates by 2% for a single week, so maybe the stock market will get into a situations that would make you lose like a large amount of value, right? So it will help us to identify vulnerability. So okay, and this type of factors will affect me easily, or this I'm ready for this type of factors. This type of factors are not going to touch my business. So it will help us to make those type of identification. Stress testing helps you identify vulnerabilities and potential capital shortfalls under the severe conditions. And the scenario analysis, this is a broader, often more qualitative approach. So you created detailed narratives of possible future. You created detailed narratives of possible future events and then analyze their potential impact on your portfolio. So I trade what I'm sorry, again. So yeah, for example, a trade war with a major partner, a new technology disrupting an entire industry, or a national disaster. So this will help you to think about risks that might not be captured in his historical data and prepare strategic response. So like for example, you can just take on the AI world, like we have just launched OpenAI, and on some time DeepSeek had released their model, right? So it was literally they were not expecting that from China or from another country. So having a plan in order to maybe having a plan for them or for that type of stock market, it means like they will add a specific or unique features to their models or to their platform so that they can release it immediately while another competitor had released their models or their LLMs or their product. Okay, so the stress testing a scenario analysis is testing our model or our market or our company. In the scenario analysis is what are we prepared for? What type of factors that are not seen yet and that might not be expected, but what type of for some factors, what type of readiness do we have? So identifying those type of risks, like the scenario analysis or testing the stress, trying to capture worst case scenarios, like seeing the standard deviation, and putting some the VAR in the shock ratio. So what is the point of putting this? Is to integrating risk into our portfolio management. Okay, so we need a risk-based optimization, which is beyond the basics. So move beyond traditional methods like the standard optimization often focuses on variance, which treats upside and downside volatility the same as we have mentioned earlier. So we use conditional value risk like CVAR, which focus specifically on tail risk, which is the potential for extreme losing for the tail risk means the potential for extreme loss or the last risk for the portfolio, and we can build more robust portfolios, which is by optimizing for CVAR with great portfolios designed to minimize the worst case scenarios, protecting against severe market shocks. And the dynamic versus static risks, which is we can stay agile. So risk is not constant, right? So a portfolio risk profile changes with market conditions. So I say portfolio can quickly become risky, right? So we need to address like the risk is not constant. The risks that we consider it as a risk for today might not be risk for tomorrow, and so we need to monitor risk dynamically with rolling volatility. So this metrics measures the standard deviation over a fixed window of time, like 30 days, to show how risk is evolving, so that we can check the standard deviation of the risk over another fixed days. So since the volatility is rolling, we need a more dynamic way for dynamically with rolling. We need to dynamically move with the rolling volatility and inform rebalancing decisions, which is when rolling volatility spikes, it's a signal to reevaluate assets allocations and potentially de-risk the portfolio before major drawdowns. Other is the true protection would be diversification and correlation, which is diversification is more than just owning different assets. So the true value is owning assets that have low correlation with each other, so that if there is a factor or if there is if there is a specific factor which might be a factor that we have seen or a factor that we have not seen, if it affects our one product, then the other is not related with this product, so the other is still safe. So this will add value on our market or company. So the true value is owning assets that have a low correlation with each other. So focus on correlation in downturn. So many assets that are uncorrelated during bear markets become highly correlated and drop together during a crisis. Right? So active listed assets that provide real protection when you need it most. So this is the core of effective risk management. So finding the assets that zik when the rest of the market sucks. So like when the rest of the market gets down, like we need to find an asset that will increase its assets or an asset that whose values will be increasing or will keep increasing while the other markets will decrease. So we can have we can have the dynamic versus static risks, and diversification and correlations will help our. We can just recommend this type of recommendation, or we can consider those values as values or as a way to get out of the risk or to minimize the amount of to minimize the damage that the risk is going to put on us. So if the risk happens. So yeah, so this, and maybe there are going to be another factors or another values that will add that will save us from the risks from happening. So like the first point is like analyzing the risk or trying to get different type of risks, seen risks and unseen risks, and trying to integrate the risks that we observe into our in order to handle them with. Okay. So maybe do you have a question on the slide or on this concept? So on trying to see the risks and the way to get out of those risks measurements. Any question, or are you like do you get the point? Anyone? Maybe some emojis. Was that clear? Thank you, Adisu. Maybe the rest of you can just show me some like. Okay, so let's just see. Let's see what type of output we will expect and what type of interpretation do we have do probably we will have. So this is literally an HTML code list, as you can see. So I have used this, so it will help us like while trying to analyze the risk. What do we mean by every variables, and what are our interpretations? So this will give us something about what we need to do on this specific risk analysis task. So the first one is maybe we can make the risk analysis in every portion. For example, on our maybe on our challenge document. Let me go there. Task one is free process and exploring the data. Yeah. While exploring the data, we are asked to document key insights like overall direction of Tesla's stocks price, fluctuation in daily returns. So like the risk analysis or the risk mitigation is kind of applied on every steps, like before forecasting, while analyzing the data, and after forecasting, after making the prediction, and also like maybe while putting some strategies to out strategies in order to avoid or in order to win the risks that we're going to count or consider. So here, foundational risk metrics. So here we were trying to demonstrate a starting point for risk analysis by showing key metrics like the value at risk and the Sharpe ratio, okay, for each assets. So what do, as we have mentioned on the note or on the on the slide, the value at risk will just tell us the we can consider we can put in a like a specific number of unconfidence a specific number of risks, and then confidence. So like the more that risk or the more value we have, it is going to be a negative value. So the more risk that we're going to have, the more we can say about that company that it have a less volatility, right? So in our example, for example, we have the three companies, Tesla, BND, and SPY. So we will definitely, as we can see from the graph, Tesla will have a value at risk of 0.049. So you can see there's an they are below zero, so the var value is always negative, okay? So, because it's the risk. So the BND and the other companies will have a larger amount. I mean, which is a larger amount of risks or a lower amount of consideration. So here you can see it's 0.014, and here it's a 0.009. So it's just calculated, okay? All the values are calculated. So we can see that the larger var we have, it's the larger negative number that we have, it's the greater loss. We might expect a greater loss from this company. So, or we can expect there is a larger volatility on this specific company. And when we come to the Sharpe ratio, so the Sharpe ratio will just calculate the assets returns minus the risk-free returns, and it will divide those values with their asset standard deviation. So this whole process will just give us the Sharpe ratio. Okay, so the Sharpe ratio, as we have mentioned earlier, it will tell us the more the higher Sharpe ratio that we have, you're going to take a risk, but for that specific risk, there is going to be a greater return or a large number of returns. So here again, the Sharpe ratio of Tesla is large, which is 1.582, and this one is 1.2, and this is 1.18. So the larger number of Sharpe ratios that we have, it's not about the risk, but it's telling us for the risks that we're going to take, there is a high return, which is also a good thing, okay? And maybe here we can see the model-driven forecast with the uncertainty. So like now we have made a prediction. Let's say our model have done a prediction. So yeah, it will show us like based on new task 23, and you're doing or you're working on or on predicting the or making a specific forecast, right? So the visualization of Tesla forecast includes confidence interval, which is a practical way to show how uncertainty or risk increase over time. So the red line here that you can see is the forecast that is made up by our model. Okay, so here It's maybe on specific confidence interval where it's 155, and it's just the date. So this is the prediction that is made by our model. Okay, so here is the forecast. On specifically, the days are here and the price is here. So the point is like this: the other the confidence interval here, or there's a line, right? And there's a shadow between them, right? So the shade will tell us the range. So on this specific day, so we're trying to make a forecast, right? On this specific October 2024, the value might not just be this one, which is maybe 161.413. The value might not just be 161.413. It might be on this range. It might be something around 161 point something. Okay, so it's not just a good prediction, actually. It's not just telling the exact value of that number, but it is like there is a very minimum deviation or minimum change. If on this date, if the price is not exactly maybe here, if the price is not maybe 159, then it is 159.12, or it is going to lie based on this interval. So it's telling us this range. So the point is, now we have this range, and now this range is like the more we go, or the more far forecasting that we're going to make, we can consider it like on the finance data. There is this logic that we can't keep the confidence. So the more our forecast is going to be far, the more far the forecast that we're going to make is, the lesser the lesser it is going to be true, or the least, I mean, the more risk that we're going to get. Okay, so this is the normal data that we're going to have, that we have actually for the historical price, and then this is the prediction. So yeah, this will tell us the uncertainty. So model forecast with uncertainty, or what amount of certainty do we have while doing this forecast. So it includes the confidence interval, which is practical way to show how uncertainty or risk increase over time. So yeah, going up, the uncertainty or the interval will, like the risk, since the range is going to be increased. So here we're sure that it will rely with this range, but coming to here, like the range is wide, so it seems like our model might not be just guessing the right number. So yeah, here it's model breeding forecast. We can just forecast the uncertainty of our model. So, and then we can see the Egyptian frontier, which is shows that the trade-off between risk and return. So now, in order to see if it is secured, if we're safe or not, so it's just calculating the risk and the risk against the return, right? So like we can just show the trade-off between the risk and return. So it helps identify optimal portfolios, such as the minimum volatility portfolio and the one with the maximum Sharpe ratio. So what does this tell us? The x-axis is the portfolio volatility or the risk, and the y is the portfolio return. So with this risk, we have this type of risk, and I mean with this risk, we have this type of returns and something. Okay, so this is the trade-off between the two. So again, as we have mentioned, the point is, or the plan or the use of this graph will be the minimum. To identify the optimal portfolio, optimal means the minimum volatility portfolio as the one with the maximum Sharpe, exactly the minimum volatility portfolio, and the one with the maximum Sharpe ratio, which is the maximum Sharpe ratio. Here it's mentioned the maximum Sharpe ratio. We'll just say that we have a higher number of return, even if there is a risk, we have a higher number of return for this specific risk. So here is we have this line. Really not good with the name of the lines. I mean the graphs. So we can just see there is a scatter plots. The scattered plots. Each scatter plots will show us specific portfolio for their returning for their volatility. So you can see that return is 31, volatility, their volatility number, their return number, and the weight for every for both the Tesla, the BND, and for all the three companies. So from this graph, what we need is like the maximum Sharpe ratio and the minimum volatility portfolio. So we have nothing in red line, which is there is no minimum minimum portfolio ratio. So yeah, let's just see. There's nothing here. So with the maximum Sharpe ratio, the maximum Sharpe, it's just going to be here, which is with the sorry, with the return of 28.28 and volatility of 2.6, or this value. So like any value with this dot, it's just a dot. So this is going to be the maximum Sharpe ratio portfolio, which is this amount of risk is have the this amount of return. So we can just take this one. And the final decision will be to have a strategy. At the end of the day, we're going to put some benchmarks, right? Uh, so like we're going to put an empirical evidence of the strategy's performance by comparing the cumulative returns of your optimized portfolio against simple benchmark. So like we can put a benchmark for a specific benchmark in order to measure our asymmetrics so that we can see how our strategy or how our measurements that we decided to take is outperforming or solving this solving this issue. So on this type of graph, or while doing that, the two things that you're going to do is the difference between the blue in the red line, which is the strategy, your strategy portfolio, and the benchmark. So while the blue one, which is your strategy, if it is greater than the rate, so then our benchmarks, our strategies are working. But if it is not, so you can, at the end of the day, like while after taking some measurements in order to control or control the risks, so then you can just see the difference between the two, so that you can compare your strategy against the benchmarks that you're going to quickly. So this, the benchmarks, the strategies, everything here, the numbers, the maximum, like if you give the concept, the other details is like it's dependent on you on what type of benchmark are you going to do, in what type of risks that you were able to name or that you were able to find out. So those depends on like your point of view or your analysis. So yeah, I guess this is it. Let's see if there is any question. Or what is, like, since you guys were working on this, so what is your understanding? In the forecasting, let's get back, and in the forecasting, which is the action. Yeah, in the forecasting, what does the false legend? Okay, that's the question, right? If I get it right. So the false legend or this shades will show us that, so they are both the confidence interval, and they show both the confidence interval and the false legend, which is uh, here we repeat, they have the same concept. So like here the shades or the graphs is going to show us here the difference between here. It is going to be the range again, right? So like there's the Tesla forecast bounded with the red line, and the interval here, there's the shade here, right? So the shade will show you the confidence or the confidence interval. But while the day goes, like if it's not going to be the same for October 2024 and for the November 2024. At the same time, um, it will show us that like the value is going to be, if we're going to forecast for this day for December 20 and for December and for the January is not going to be that much. The January prediction is not going to be that much safe as it is for the September, for the October and for the November, because the prediction is like the prediction is made for a long range of time, or for the like literally for the far future. Okay, so the probability of the model trying to predict the right value for the prediction is going to be minimized. So it is considered as the false value or the false range that the value or the price is going to rely on. So this is not the right value of the it seems like this is not the right forecast, or this is not the right price that the price of the market is going to be on that specific time. So at the same time, it is the confidence interval, but as the days go on, it have the potential of showing us the false intervals or the values that the model will predict that it is not going to be correct. Is that clear, Danny? Any other question? Do you have any question or anything to say? Anything to add? Okay, in that case, we can end the session here. Oh, I'm sorry. Thank you everyone for being here. Let me stop the recording and we can stop the finish the session.